The date investors have spent months waiting for.
The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March.
US Federal Reserve Chair Jerome Powell signaling it's likely to start raising its benchmark rate from near zero 2 years after it was slashed to save the economy from COVID-19. And the decision to end this era of cheap money that stimulated borrowing, spending and hiring has been on the cards as conditions improved. But that low rate has also been blamed for fueling the highest inflation for 40 years and forced the Fed into hiking rates much faster than it intended.
High inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
But if Powell's decision answers some questions, it raises a fundamental one. Is the US ready to switch from low rates that have helped supercharge stock prices to higher rates that make borrowing more expensive?
You're not pouring gasoline on the fire, and you're raising interest rates into a market that hopefully will be strong enough to absorb it.
That will depend on how quickly the Fed tightens.
The question for investors and anyone engaged in any kind of financial planning is how many times that benchmark rate will be raised this year. The Fed thinks that unemployment is now low enough to handle that kind of tightening, and yet continues to describe the economic outlook as highly uncertain. And yet with inflation surging, there appears to be no alternative to raising rates. Owen, Fairclough, CGTN, Washington.